Let's bring in Joe Livornia of SMBC NEC Securities America. He's also the former National Economic Council chief economist. Joe, great to have you with us.
Thank you.
What are you looking for? Do you think 5% is the pain point for the Fed?
Yes, probably. It's a nice round number. It's a lot higher than where we are now. If the economy shrinks 2% next year, which would be an average recession, relative to trend growth of 1.5, 2, that'd put the unemployment rate up around 5.5 or 6. So Guy's point is accurate. It does take a while to get there, but we could have a much different labor market 12 months from now if we have a hard landing, which is what I expect.
Do you think that the Fed stops its pace or stops its hikes before that 5% number if it sees things are going towards 5%, that things are loosening?
Yes, definitely, Melissa. I mean, the Fed has talked very tough, but right now they could hide behind low jobless claims and a pretty decent labor market. They're going to fold pretty quickly, in my opinion, if the job market starts generating 100,000, 200,000, 300,000 job losses a month. It won't matter where inflation is. The Fed knows inflation is a lagging indicator. The market will leapfrog any of the future weakness in inflation, will start to price in Fed easing, and the Fed will be cutting.
Joe, I mean, people saying they're making a policy mistake now. I would submit it was made many years ago. It doesn't matter. We talk about the Fed put for the S&P 500. I think it's maybe 3,000. Does it exist? And if so, what's your level for it?
3,000 is probably the right number, because at 3,000, you'll probably see credit spreads widen dramatically. That, to me, is probably more important, because when the Fed gets worried about solvency issues, then they really start to move aggressively on the easing and start to re-expand the QE, which is what basically happened in 2019. They stopped the unwind. They started to expand the QE. They cut 75 basis points. So if S&Ps are 3,000, you're probably looking at high yield up another 400 or 500 basis points. There'll be more talk of solvency. There's already liquidity issues in the Treasury market. So I think there's more signs of fragility than perhaps what meets the eye. And in that kind of environment, the Fed will be at least stopping the QT and maybe pivoting then for an ease.
Joe, let's talk about QT for a second, because to what extent could you attribute any of the backup in yields at this point to have anything to do with the Fed in terms of the balance sheet unwind? And at what point do you think this also will have upward pressure on interest rates?
So, Tim, the balance sheet is really impacting liquidity, and you've got an inverted yield curve. So I don't think that it's been a function of the balance sheet. It's been a function of where the market thinks the terminal rate is. And with the exception of the move last week in gilts, which pushed the yields up to 4%, basically the third month out Eurodollar contract, fourth month out or fourth contract out has basically predicted 1-for-1 the movement in the funds rate. So, for example, if the Fed was to start pivoting in the spring, which I believe is very possible, you'll see the 10-year note rally substantially.
You know, Joe, all of these forecasts are being made assuming that the Fed is going to act, and we're living in a certain world where these things are in place. But, you know, there's an interesting thing going on in California right now, where they're handing out stimulus checks to people. And I'm just thinking, you know, that the path to 5% for a lot of Americans will be a tough one, especially if inflation remains sticky. Are you concerned that there won't be political will on the part of states or local municipalities or even the federal government to actually allow that pain to be inflicted, and that will, in fact, derail the Fed's work?
Well, I mean, there's no question that giving people money to pay for high energy bills, while it may help the household, will do nothing to stop high energy costs. You need more supply. You need more drilling, more oil expansion, more everything in terms of energy output, clean as well. I want to be politically correct. But to me, where you'll get the political blowback will be the Fed itself, because the Fed now is accountable for all its actions. It's very transparent. It said it wants to get inflation down. It can't hide behind the reserve procedures, the non-borrowed reserve procedures that Volcker operated under, where they actually didn't target interest rates. They targeted the money supply. So to me, Melissa, that's where the blowback will be. You've already seen the UN. You've seen, I believe, the IMF. We've seen a few senators already come out against the Fed. Can you imagine what happens as those rates go up higher? The economy weakens. We're paying hundreds of billions of dollars to banks because of the excess reserve payments we're making, and the unemployment rate's deteriorating. I mean, can the Fed really have the gumption and the backbone to stay pat? I don't think so.
Joe, great to speak with you. Thank you.
Thanks, everybody.
Joe Livornia. Karen, what do you think?
I mean, I don't love the idea of just giving money away. That's sort of how we got in this situation, right? And so to the people who need the money, obviously, they need the money. But, you know, I think our last stimulus was really problematic. And so this is, I guess, a mini one. Yeah. But I can't see, it feels like, you know, adding oil to the fire.
Well, this is policymakers fighting each other, central banks, you know, again, fiscal monetary tug of war after the central banks. Look, the central banks did this forever. And they made it really difficult on policymakers because it was basically financial oppression. When rates are zero, people can't save, middle class gets screwed. But this is what we're seeing. You can't give money away.
What I find interesting is I think there's, and I'm not suggesting any of us, but if they were to pause, nothing happens on the back of that other than the stock market goes higher. I would submit if they pause.
For a while.
Guess what? No, but I think the commodities market is going to explode to the upside. So the inflation problem that they think they have under control is just going to get that much worse. This genie is out of the bottle, and it's very hard to tamp it down. And they're going to learn the hard way, I think, that lesson if they do decide to pause.
So they have to stomp it down as opposed to just
stomp it. Like when you see that ant,
and
you can just stomp that sucker.
I don't do that, but it sounds like you do.
I suspect it happens probably sooner than we think, and we were just talking about financial conditions. If you look at the LQD, this is the investment grade corporate bond ETF. It's down 23% from its highs last year. That's basically more than the S&P 500 is down. So if you think about it, obviously this is corporate debt. So all the things that you're talking about in high yield, that's much worse right now, right? And if you think about just where, where valuations are, where the economy is going, if we do get to 5% unemployment over the next 6 to 9 months, our economy is not going to be in a great shape, and they're going to have to pivot. So I suspect towards the end of this year, we're going to get some sort of, all these Fed governors are coming out here and saying we're going to be hiking into next year. I think we're going to see them a bit quieter towards the end of this year.